You're making a good salary, maybe even top 20%, but by the 15th of the month, the math just stops working. Your account feels like a leaky bucket, and you're left wondering where it all went. Every paycheck filters through two mentalities, the status spender or the wealth builder. The status spender buys new SUVs and branded clothes for external validation, draining their salary into EMIs. Meanwhile, the wealth builder lives modestly, channeling their surplus securely into real estate and SIPs. By aggressively chasing visible success, the status spender locks themselves into a prison of fixed monthly liabilities. There is zero capital left over to maneuver or invest. The result is your peak earning years, the decades where your energy is highest, are spent paying compound interest to a bank instead of compounding assets. Prioritizing the appearance of wealth is the exact mechanism that strips you of the mathematical ability to actually become wealthy. Let's look at where the largest chunks of capital vanish, starting with the immense societal expectation of the big, fat Indian wedding. We're talking lavish 3-day setups engineered for flawless photos. To meet this expectation and protect the family's social standing, middle-class parents and young couples routinely take out massive, high-interest personal loans. Look at the math on this table. A 1 lakh rupee personal loan right now sits around 10.65% interest. That's roughly a 5,000 rupee EMI for 2 years, meaning that 1 lakh of borrowed status actually costs you about 1.2 lakh total. Now, if you take that exact same 5,000 rupee cash flow and put it into an SIP at a 12% return, over those same 2 years, you build up 1.36 lakh. You are actively losing money to fund an illusion. We apply this exact same flawed logic to our driveways. There is a perceived necessity that progressing in life means constantly upgrading to a brand new expensive car. But a car is a depreciating rock. Beyond the sticker price, it anchors you to compound interest, mandatory high-tier insurance, and constant maintenance costs. If your daily commute is under 30 kilometers, relying on cabs or buying a well-maintained used car provides the exact same utility, but without the suffocating debt anchor. Every macro loan you take out to impress other people is another link in a chain that pulls tighter around your monthly cash flow. When you fund these milestones with credit, you are trading 3 days of social praise for a half-decade of financial stagnation. Beyond these massive events, a more subtle drain happens through frictionless living, a collection of daily habits designed to feel invisible. If we plot the things we buy on a chart, measuring the physical friction it takes to purchase them against the long-term value they retain, a dangerous pattern emerges. The highest risk area is the bottom left corner. This is where food delivery and e-commerce sit. Zero friction to click order, combined with zero long-term value retention. We think we're being efficient, but you are routinely paying markups and delivery fees of 20% or more, simply to save 20 minutes of walking to a local shop. This psychological trap extends to the buy now, pay later culture of branded fashion. People are literally financing shoes and jeans, paying massive markups just to wear a corporate logo. The irony is that the ultra-wealthy actively avoid this. You don't see massive logos on the people who actually control capital. Steve Jobs built one of the most valuable companies on earth wearing a basic, unbranded black turtleneck. Frictionless apps and premium logos do not upgrade your lifestyle. They quietly subsidize corporate marketing budgets while draining your own investment surplus. To survive the relentless pressures of convenience and status, you need a systematic defense for your capital. The default middle-class operating formula is mathematically flawed. It looks like this: income minus your spending equals whatever's left over for investing. A wealth builder flips the equation. Income minus investing equals spending. You automate the investment immediately when the paycheck hits, before a single desire gets funded. To enforce this, start using 2 behavioral frameworks. The first is the 24-hour rule, built to break the dopamine loop of online shopping. Before you hit checkout on any digital cart, force a mandatory 1-day waiting period. Spend that time asking if there's a cheaper alternative. If you still need it tomorrow, buy it. Most times, the urge evaporates. For larger lifestyle upgrades, use the second framework, the 2x rule. The rule is brutal but effective. You can only afford a luxury item, like a flagship phone or a premium watch, if you have the liquid cash to buy it twice, right now, without feeling any financial stress. These rules act as a seawall. They force your impulsive spending habits to crash against a solid barrier. By introducing deliberate friction back into your life, you secure your financial independence first before you start funding your current desires. Ultimately, it's a choice between two operating systems. True wealth is quiet, while poverty is loud. Prioritizing social validation on the status spender path gives immediate comfort, but the final bill is working past 65 with high financial anxiety. If your primary goal is long-term freedom, options, and peace of mind, you have to choose differently. The wealth builder path requires delayed gratification and strategic friction. You have to be willing to drive boring cars, live in older homes, and completely ignore what your peers expect of you. The people society deems most successful, based on their visible possessions, are often the ones operating closest to financial ruin. You are standing at a split in the tracks. Every purchase pushes you down one path or the other. Audit your last 3 major purchases. Ask yourself, were you buying an asset for your future or an audience for today? The answer determines whether you're building wealth or just financing an image.